Hey guys, and welcome back to the channel. MD Investor in the house again. MD Investor, the channel where we talk about personal finance, breaking the cycle of generational poverty, financial intelligence, and living a life that we were meant to live. Thank you for your subscription on YouTube at MD Investor. Thanks for your subscription, your like on Instagram at MD Investor 1. Let's get back into it, guys, in another video. Today's video is your financial advisor is robbing you blind. That's right. And you don't even know it. Your financial advisor is robbing you blind. The other day, a friend of mine that went to medical school together was asking me, Wayne, how long have you been involved in this investor stuff? And I said, well, it's a couple of years. After I realized my financial advisor was robbing me, absolutely robbing me, and I had no idea. And guess what? A lot of your financial advisors, guys, are robbing you too. You might say, I don't even have a financial advisor. Well, if you went to human resources and they said, okay, check this box, check this box, check this box in A and in group B, check this box. They were probably putting in some pretty crappy investment and you're probably being robbed, okay? The other day I went over some investments of someone, and it just basically illustrated this point clearly, that the financial industry is robbing us. And I would say we are to blame, but I'm gonna kind of hold back a little because we've been indoctrinated that this stuff is way too complicated. I mean, we see all these commercials with TD Ameritrade, E-Trade, Charles Schwab, all these places, and these people got on suits and they look so educated and talking about asset allocation and risk tolerance and time horizon and stocks and ETF and mutual funds, and your head is exploding and this is too much for me. Let's hand it over to the professionals. They know what they're doing. And they have my best interest at heart. Really? Is that really true? Do they have my best interest at heart? Do they have your best interest at heart? Are they really trying to make the most money for you? Or are they really trying to make the most money for them? Let's think about it, guys. There's two parties in this. There's you and there's your financial advisor. There's you and there's your financial advisor. Your financial advisor wants to make money. Let's think about it. That's the whole idea, right? They want to make money. And do they make money by putting you into the best products for you? Or do they make money by putting you into the product that give them the most commission? Let me think about it. If I put you in this product, you'll make a lot of money, but I won't make that much. But if I put you in this product, it could be inferior, but I'll make more money. Let's see, what should I do? So you see the dilemma, right? The products that they put you in are most likely going to be the product where they're the most commission to make them money, even though it's not the best thing for you. You ever heard of the word fiduciary? A couple of years ago, Congress, I think they were trying to come up with a bill to say that financial advisors should adhere to the fiduciary standard, which just basically means they have to do what's best for you, what's in your best interest. And because they have a strong lobby, the banking industry, the financial services industry, they have strong lobbies, right? They give hundreds and thousands of millions of dollars to congressmen. So of course, they're going to fight that. They want to put us into what's called suitable. What does that mean? Well, suitable just means it's suitable for you. It doesn't mean it's the best for you. It's suitable. Fiduciary means they have the obligation, the right to put you in what's best for you. They didn't want that. So they don't want to do what's best for us. They want to do what makes the most money for them. So now I'm going to put some responsibility on us. We have the commercial from Capital One, that says, what's in your wallet? Now I'm going to ask you, what's in your investment portfolio? What's in your investment portfolio? Last video we talked about. Last video we talked about retirement, and we're talking about Roth, not Roth. We're talking about 401k and 453 and 457 and all these things. 43b. I mean, my mistake. But those are only accounts. The investment is what's in it. If you are taking the advice of these people that don't have your interest at all, what's in it is going to be a whole lot of junk. Give you an example. I looked at someone's investment portfolio very recently, and on it, it had a front load of 5.50%. What does that mean, front load? You have mutual funds, and they have load attached to it. Some of them are no load, but frequently the actively managed fund, they have loads attached to it. They can be, and basically these are the fees, to be honest. They're just fees. They could be front end load, or they could be back end load. I'm just going to read something to you real quickly. A load mutual fund charges you a sales charge or commission for the shares purchased. Can you imagine that? You want to purchase this investment, and they're going to charge you a sales charge or commission for the shares purchased. Where's that money going to? Your investment advisor getting some money in his pocket. They can be front end loads or back end load. In this particular example I was telling you about, the front load was 5.50%. Front load funds, also known as Class A shares, is a single charge paid by the investor. Yeah, us. Paid by the investor when they purchase shares of the fund. So imagine this, right? You're doing your thing, you're working, you're saving, you're investing. You want to buy this mutual fund recommended by your investment advisor, and they're charging you a fee up front. Then you have back end fund or Class B shares, and they charge a one-time fee paid when you redeem or when you sell your mutual funds. So they get you going. No, correction. They get you coming in the beginning in this front load, or they get you going when you're selling it in the back end load. So let's go back to the example I was talking about. So this person investment, we went online, we're looking, typing it up, just like I told you guys, go check out what you have. Don't make no assumptions. Go check out what you have, right? And the reason why I say that is, don't lie to me. Don't pee on me and tell me it's raining. Okay? Tell me the truth. But they're not gonna tell you the truth. So you gotta go, there's information all out there. Go, log into Google, put in the ticker symbol, and right on the website, you're gonna know the what the share is, what it's being charged, what it's being called for, what it's trading for right now, the front load, and there's an expense ratio. We're gonna get to that in a minute. So this had a front load of 5.50%. What does that mean? Well, that means for every $1,000 you invested in this mutual fund, and it's an actively managed mutual fund, meaning they have actively managed trying to pick the right stocks to put in the funds. So 5.5% front load, for every $1,000 you invest, 5.50% or $55 is being taken out. Just for you having the opportunity to buy this mutual fund. So you invest in $1,000 and you're thinking the whole thing is going in to work for me. No. 5.5% or $55 is being taken out. Now what's left? Only $945 is left. Now, with this particular investment, there was an expense ratio of 0.93%. There was an expense ratio of 0.93%, which means for every $1,000 you invest, $9.30 was being taken out as an expense ratio. What is an expense ratio? An expense ratio is basically the fee that the mutual fund incurs. The fee the mutual fund incurs to pay the people and so on certain expenses. 0.93%. 3%, which is considered a pretty high expense ratio. Um, so let's go back to our example. $1,000 you invested, a front load of 5.50%, meaning $55 already gone out of 1,000. You're only left with $945. And an expense ratio of 0.93%, meaning $9.30 out of every $1,000 is being taken out. So what's left? $935.70. See that? You invested $1,000, but because of fees, you're down to $935.70. You thought $1,000 was working for you, but no, only $935.70 is working for you. Those other, call it about $65, fees to your investment advisor, and some money also going to the people who are running the mutual fund. This is the stuff that makes you very, very angry. And this might go on years and years before you even realize, because you're thinking they have my best interest at heart. The ticker symbol for this mutual fund, just so you guys can check it out and realize that I'm not lying to you, is PGIM. PGIM. Go check it out for yourself. The other mutual fund that this person was in is ticker symbol PBQFX, an expense ratio of 1.91%, considered extremely high even for actively managed fund. Extremely high, 1.91%, which means for every $1,000 that you invested, $19.10 was being taken out for fees. What's left is only $980.90. Big difference. The average mutual fund expense ratio is about 1% for actively managed mutual funds, meaning mutual funds where the managers try to pick the right stock and try to beat the market. The average mutual fund is about 1%. So this 0.93%, you can say was maybe around the average. This 1.91% is considered extremely high. You see the money is being taken out even before it even gets to work for you. In this particular example we gave you with the front load of 5.5% and expense ratio of 0.93%, combine those, that's almost 6.5%. That's almost 6.5%. Even the stock market, the average annualized return for the stock market over the last probably 90 years, it's been about 9.8%, so a little under 10%, and about almost 6.5% of that is being eaten away. You only have a few left, maybe about 3% left, barely above inflation. You see how after years and years, all the money they've eaten from you, and you have not gotten anywhere. It's like you're walking in quicksand because of the fees. So we said the average mutual fund expense ratio is about 1%. That's for the actively managed fund, as opposed to an index fund. An index fund is basically a passively managed fund where the fund tracks an index, such as the S&P or Standard and Poor S&P 500 index fund. So the 500 biggest companies in America, the big name that you know, Apple and Google and Home Depot, all these big companies, and they basically just track them, and they're very passive, and their fees are very low. The average fee or the average index fund for the average fee for the index fund is about 0.05% to 0.07%. So we're talking about maybe 50 cents for every $1,000 that you invested. You see the difference? And now you might say, well, the average fee for actively managed mutual funds is about 1%. And for index funds, about 0.05%. It's not a big difference between 1% and 0.05. It's not a big difference. But let me give you this example to show you the difference. Imagine someone invested $6,000 into their Roth IRA, which is now is the standard contribution limit now for 2019. They've invested $6,000 in their Roth IRA, right? They're getting about an 8% return and it's an actively managed mutual fund with a 1% expense ratio. Okay, 1% expense ratio. So obviously now from 8% return, you probably only go down to 7%. After 40 years, you're going to end up with $87,199. Let's repeat that. You're contributing $6,000 to a Roth IRA for 1 year. You're getting an 8% return, and there's a 1% expense ratio. After 40 years, you end up with $87,199. Compare that now with an index fund, a passively managed investment, with an expense ratio of 0.05%. You're still getting the same return, 8% return. After 40 years, guess how much you end up with? $130,347. With the 1% expense ratio, you end up with about $87,199. With the passively managed index fund account, you end up with $130,000. A $43,148 difference. See that difference? $43,148 difference between one account and the other. Both of them getting 8% return. Both of them invested $6,000 Roth IRA. We both let it run for 40 years. One of them has an expense ratio of 1%, and the other one has an expense ratio of 0.05%. And there's a $43,148 difference. And that's only 1 year. Imagine after you've invested for 40 years, the amount of money you're going to lose. It ain't going to be $43,000. It's going to be probably $400,000, $500,000, $600,000. I've heard examples of people ending up with where they should have ended up with $1 million, but because of fees, they only end up with $400,000. The $600,000 difference is from your advisor. That's why I don't like financial advisors. I do not like financial advisors. I think they put you in subpar investments that cannot beat the market. If they can't beat the market, why do I have them? I might as well be the market and get an index fund and use very low fees and keep most of my money. What do I need them for? So, and this is another example that kind of hit home. Is that the fund manager would have to beat the market by at least 0.95% every year to make up for the expenses. Meaning, because their expenses are eating away at the returns, they'd have to beat the market by at least 0.95% just to make up the difference. And as we'll go into other videos, you realize they cannot beat the market. Warren Buffett said on his death, the money he's gonna leave to his wife is gonna be, he wants it to go 90% into an index fund and 10% into government bonds. I mean, if one of the best investors out there is saying that the index fund way is the way to go for the average person, why am I gonna try to beat it? Okay? So guys, just a quick video, guys, about why I'm so passionate and why, as the commercial said, what's in your wallet, you have to see what's in your 401k, what's in your retirement, what's in there. So I said, before this year is over, guys, before 2019 is over, definitely it behooves you to go online, look up what you are invested in, and please take note of two things. Whether you're paying any loads, whether it's front load or back end loads, and also at the expense ratios. Those are two killers that's going to eat away at your return. Absolutely going to kill your return. The answer, guys, is passive index investing. Okay? Passive index investing with low fees, and you get a better return. You keep more of your money. After all, you're working for it, guys. So just a quick video, guys, just to open our eyes that they are robbing us. That financial advisors are robbing us. And now that our eyes are open, guys, we got to take responsibility. We got to go, and you absolutely have to make it stop. I remember when my eyes were open, it was very quickly, I called my financial advisor. I said, I want you to transfer all of my money to Vanguard, got it in an index fund, and I've never regretted that decision. So quick video, guys. If there's anybody out there, guys, who think you can benefit from this personal finance information, let them know. Again, don't forget to subscribe to MD Investor. MD Investor on Instagram, MD Investor One, guys, trying to open up the people's eyes. Open up the people's eyes, guys. I'll see you in the next video.